Well, hi everyone, and welcome to the InvestSMART Bootcamp. This is week one. I'm Tom Wilson. I'm one of the product specialists here at InvestSMART. I'll be taking you through the week one content, which covers off module one, investment planning, and module two, diversification. Probably one of the two most important modules, I think, in this whole bootcamp experience. So as always, we'll start off just with the disclaimer. This is only general advice, so you should only take that as general. It's not specific, which means we won't be able to answer questions that relate specifically to your financial or personal situation. So about this webinar, so we have 4 webinars that cover off the 4 weeks of learning. Now you can take as long as you want in terms of going through the content. You've got access to the content for 90 days. So you could do modules over the period of 2 weeks or even 3 weeks if you wanted, doing it at your own time when you get a chance, because a lot of us are busy. And these webinars are designed to complement any questions that you might have as you're going through the learning material. So if you come across something that you don't grasp quite completely, or you're not understanding the concept, this is one of the best places to ask for it and get a question answered. There's actually an opportunity on the right side of your GoToWebinar box there, and it actually lets you ask questions. So definitely pop them in. And you can also put questions in when you're registering for the webinars. So before the webinar takes place, we get a list of questions, and we can even cover off some as we go through as well. And if you can't do that, you can always send us an email here at investsmart.com.au. So we'll always try and cover off or help you out with any questions related to the bootcamp content. So we don't give personal financial advice, just general only. If we ever do get questions about that, we'll during the webinars, try and relate it back to the topic, or even try and make it general. We do need to stick to the course content. So this is the first week, so we'll try and stick to questions that relate directly to investment planning process and also diversification. If we get questions that are outside of this, I'll take a look at it and see whether I can answer it during the webinar. But if not, I can get back to you after, or even refer you to one of the previously recorded weeks where we do talk about that. It's also an opportunity to make sure you're using the available resources that have been given to you. So when you signed up for Bootcamp, you've actually got 1 month free of both Eureka Report and also the Intelligent Investor. And there's so much information and education on there as well that we quickly run through that just to make sure that you understand where to find this information and then you're using it or utilizing it to your best ability. And just remember, this is an introductory course only. It's covering off the basics. So it's not a second or third or first year uni subject. We won't dive deep into equations that are complex or deep theory. By all means, if you've got questions about that, I can point you in the right direction. But this is more of a primer. So if you look at the first resource that we have available, it's the Eureka Report. And this is headed up by Alan Kohler, who you might have seen on ABC News each night, presenting the finance. Has some of his always interesting charts, which you can actually find on the Eureka Report here. So he's the chief editor of Eureka Report. And one of the best things that a lot of users find is that he gets access to a lot of company CEOs, politicians, founders of companies, and interviews them and asks them a lot of questions that you don't normally get answers to. He's really good at the interview process and also deep diving into why a company is doing something or what their future moves might be as well. So it's a really good resource for that. There's also a lot of education in there as well. The Ask Alan feature on the website or on the Eureka website is very popular, and a lot of people ask questions there that they want like a straight answer to. And Alan's really good at that. So what you can do is you can pop your answer in there along with your first name and submit it. He may not always have a chance to get to it because he takes a lot of questions each week, but you can definitely put it in there. And also you can review questions that have been covered off previously. And I might just take this opportunity to jump in and let's have a look. So Eureka report. So if you go to the InvestSMART website, investsmart.com.au, it sits at the top here, Eureka report, or you could go straight to it, eurekareport.com.au. And you just need to use your login, your InvestSMART login that you would have gotten that has your trial attached. So what I might do is just quickly log in myself. So you can see here that you've got the Ask Alan section at the very end here. So you can submit and view questions. And this is a really good resource because what you can do is not only ask your own question, of course, but you can actually review previous questions. So there was a question here about investing in infrastructure 4 weeks ago, which Alan went through when he was chatting with James Kirby from the Australian, I believe. Alan also writes for the Australian as well on the weekend, talking about Bali, talking about modern monetary theory and superannuation there, holiday house market, really interesting. So a lot of little areas if you want to go off into a tangent, but then there's RBA and government bonds there as well for those who are interested in that. And we do cover off that kind of stuff in this bootcamp, but you'll see that there's also sections at the top here that talk about specific areas as well. One person who I'm always fascinated with is Elizabeth Moran, and Liz talks a lot about income, particularly with asset types such as bonds. And she even has articles where she walks through over a series of articles how to understand bonds and what you might want to use them for in terms of investing. And we definitely touch on that as well. We use her articles as a good resource. Apart from that, you've got on Eureka Report Alan's charts that live here, the ones that he shows on ABC every night. But you've also got filter tools here. So the filter tools, I can spend ages on this myself, and it lets you search through different areas. So even directors' interests, and that's a really fun one because you can see what directors of companies are buying or selling. And that's usually, it can be a sign that there's change afoot. So you can see here there's a number of recent entries. So New Farm on the 2nd of October, one of the directors of Murray McDonald's, she's bought some shares indirectly at this price, this much. So what someone might think is that, okay, that seems like if she's buying into it, that might be a confidence type thing. That means that she could be expecting the price to go up or the company to do better. Obviously, you take everything with a grain of salt and do your own research, or even look at the Intelligent Investor, which we'll touch on that as well. So the Intelligent Investor is the other website you've got access to, and it's really good for share recommendations, research, and it also has its own portfolios inside there as well. You can see that straight away there's on this page some recommendations, but let's check out the website as well. So that lives at the top here, Intelligent Investor. I can click on that and it would take me to this webpage, or I could always just type in intelligentinvestor.com.au. And you can see here you've got on this main page the latest recommendations. I can click on see all if I wanted to go to the entire list. And you've also got the latest research here as well. And if they're talking about certain companies, you'll see they have the recommendation in there also. Let's have a quick look at recommendations. What I'll do is I'll quickly go to the word value investing. And this is a really good spot too. We cover this off in a further bootcamp module talking about value investing, what it is, and how you can use it as a strategy. But this is one area that covers it off very well. because intelligent investors themselves use value investing. So they search for value in terms of their strategy, and they explain it quite clearly here. They also show you what they mean by their buy, hold, sell, and understanding the risk ratings that they've got, but also understanding what does a buy actually mean. Does it mean that you jump in straight away, and they explain each one here. So I'll go back to the top and let's have a look at the recommendations. We'll go straight to latest. So these are just for the latest ones. So they've got News Corp there as a hold. James Carlisle was the analyst that delivered that, and that was on the 7th. So that was yesterday. He reviewed it. Price at review was $19.60. Current price at the moment is about $20. And they're saying if it gets below the 15, that's when you should look to buy, and you should look to sell or get out of it at $25. Then the max portfolio rating, that's based on what they think. If you had a portfolio with their recommendations, you wouldn't want to go more than 5% of that portfolio with News Corp. But again, it's completely up to you. You might choose to go less. You might choose to go more. That's just from their perspective. They've also got stock screen tools here as well, similar to the Eureka report, that let you go through all the different types of assets and shares there too. They got their own portfolios, which means they have actively managed funds where you've got analysts who are picking and choosing different stocks to go into this fund. And we recently, as of Tuesday, we just launched the Intelligent Investor Growth Fund, and it trades on the ASX just like a share under the code IIGF. So we launched that on Tuesday. It's made up of Australian shares or Australian equities that the intelligent investor thinks are undervalued and might present opportunities for capital growth, so going up in value. It listed on Tuesday at $2.50. It looks like at the moment the indicative net asset value, so what the value of a unit in the fund is worth, is $2.51, so slightly above where it was issued. And it talks obviously about all the different timeframes in here as well, and different kind of risk. Product disclosure is always important, so definitely have a read of that if you get the chance. So those are the two resources. You've also got on the InvestSMART website itself, we do have tools such as calculators to work out how to build wealth or property, comparing your fund, term deposits, so you can compare, and other areas as well. We have insights that are free, so you can read articles written by different contributors, including our chairman, Paul Clitheroe. He writes a lot of stuff on here as well. Okay, so module 1, it basically has 3 main components to it, and that's understanding that you need a goal. So you need somewhere, or need to know what you're actually aiming for, time frame, and you need to understand your risk profile as well. And remember, if we're going through this and you think, oh, gee, I'm not sure what that means, or can you please explain a bit better, definitely pop in a question and I can see it and we'll tackle it. So looking at goal, it's basically, what's my reason for doing this? Why am I wanting to invest in something and wanting to grow my money? So you definitely need to sit down and figure out what you're trying to achieve. And like most people, you'll tend to have numerous goals, so multiple goals at once. So you might have some that could be, I want to retire. And if you're in, say, your mid-30s, which is what I am, you might decide that that's a long-term goal for you. You might have shorter-term goals. And the example I always use is that I'm trying to save for a house deposit. So that's my goal. My goal is to save up enough so I can go to the bank manager and say, I want a loan for a house. This is how much I've saved. So the second part is that I need to look at how much time, or how much time is required, or how much time do I need, or do I have other time constraints? You might have someone who is perhaps in their last few years of retirement, which means that they're constrained to 3-year time period. As I mentioned, for me, I've got a long time in terms of retirement. So I've got a very long time horizon. The example, though, we use here is the saving up for a house deposit, and I want to buy a house in 3 years. So for me, that's given me a 3-year time frame. The third part is risk. How do I feel about risk? So it's not in a sense that if you said to yourself, I'm a risk taker, I'm happy to jump in and go high risk, even if it means it doesn't match my time frame. That's not exactly what we're talking about. It's more of, can you sleep at night time if you're invested in a long-term investment and you know that it will fluctuate over that 5 to 7 year period? But if you're someone who checks daily your long-term investment and you get anxious or a bit worried about the fluctuations short-term, you might have to categorize yourself as someone who doesn't really handle risk too well. So that can affect what kind of products you might want to be investing inside of. For myself, if I look at my long-term view, if I say for the retirement, I've got like 30 plus years, if not more, before I retire, I'm happy to take a longer term time frame, but also a higher risk, because I know that over that period, there will be ups and downs, but on the whole, I'll get a higher return because I understand my time frame and I understand my risk. I'm not going to go to bed each night checking my super going, oh, gee, it's down 1%. Oh, it's down 2%. Oh, it's up 1%. Oh, it's down. I won't be doing that. It's not something that I need to do because it's very long term. In my specific example, I want to buy a house. So in 3 years' time, I want to be able to go to the bank manager and say, I've done this. Here is the amount. I don't want to go backwards. So that immediately means for me is that I don't want to hop into something that is going to be high risk, because in that 3-year period, which is relatively short in terms of investing, I could go backwards, and I don't want that. I want to be able to go to the bank and say, I've done it, here is the money, let's get started. So that means straight away it's going to put me into investments that are probably more conservative, more defensive, where I will sacrifice some return, but for the sake of less risk. So we always use examples of the InvestSMART portfolios, and we use these because I'm familiar with them because they're our product. There are numerous products on the market. We do think these are pretty good because we do things like cap our fees, which means that the money that you would normally pay to have someone manage these for you, it stays in your pocket. You get the benefit of compound returns. What I might do is actually just jump to the website so you can see this. So I'm on the InvestSMART website. If I go to Invest With Us, this is the same page that screenshot's from. So you've got diversified portfolios, which is what we'll cover off shortly in this webinar as well, talking about what is diversification. But you can see that there's 4. There's conservative, balanced, growth, and high growth. And each of them has a suggested time frame. So the time frame is the minimum suggested length of time for this investment. And what that means is that if I'm someone who's only got a couple of years before retirement, the conservative might be something to consider. And it suggests having your money invested in this for 2 years at least. You don't have to. You can always leave this particular portfolio at any time. Your money's not stuck in there like a term deposit, but it's just saying that over the period of 2 years, there could be, for conservative, it's not really going to fluctuate too much, but there is still an element of some shares in there to get growth. So it's suggesting a 2-year time frame. The balanced is a 4-year time frame. So for me, my 3-year time frame, it sits right in the middle of this. So if I was to choose 4, it would probably be a little bit too risky for my time frame. So I would stick with, say, 2+ years. So that means that it's saying here that on average, since this has been created, since 29th of December 2014, after all the fees I pay, the management admin fees, this is the return I can expect on average per year. So 4.1%. So that's how much my funds on average will grow. And this is, of course, an estimate. It's based on previous returns. You could have the next year being much higher or much lower. The estimated income per annum is 2.2%. So that's forward looking, and that's an estimate of what I could expect to get in terms of income. And income is interest or any kind of dividends. So that's forward looking. And this one is past performance, which actually incorporates any income paid. So if I was to say extrapolate the 4.1%, it's probably not the best thing to do, but you could say, well, based on the previous performance of 4.1, there's an estimate that I could keep getting 4.1% per year, which is not often the case. You have to always we can't use past performance as future performance, but it gives you an idea, at least. It's one way in which to try and give you an idea of the performance of the fund. So we spoke about diversification, and those 4 portfolios I pointed out to you are diversified. But what does that actually mean? It's sometimes just a bit of a buzzword, some people think, but what it is the spreading of risk across different assets. And what a lot of research has shown, particularly even academics, is that if you spread your risk, if you put your eggs into different baskets, you tend to lower the risk overall, and you avoid any kind of large fluctuations to your money, to your investment. And the example I always use, because it's relevant, and I remember this quite clear, was my grandfather's experience with diversification, or should I say lack of it. So my grandfather was, like most Australians, quite excited when Telstra listed on the stock exchange, and he went out and bought a holding, or he applied for a holding in Telstra. When he was issued it, he was very proud, and he was like telling me how he owned shares in Telstra. But luckily, my father, who is also in finance, did sort of have a chat to him and said, are you diversified? Have you spread your risk? And he hadn't. He basically put all of his money just into one Australian share, which was Telstra, which meant that if Telstra had a bad day, then his whole portfolio would have a bad day as well. So if Telstra dropped by 5%, his portfolio would be down by 5%. So he thought, well, I need to diversify. I need to spread my risk, not just be stuck in Telstra. I'll go and buy something else. And he bought Commonwealth Bank. Is he diversified? Probably not. He's now got a holding in Australian communications company, but then also an Australian bank. But he's still stuck, at least, not only in 2 shares, but he's also stuck in just the Australian market as a whole. So if you looked at it, if the Australian market had a bad day, the good chance is that his portfolio would have a bad day as well. If it had a good day, then his portfolio would probably have a good day also. So he hasn't really diversified as of yet. So is it diverse if you only have 1 share? Definitely not. Is it if you have 2 Australian shares across 2 different sectors? Not again. You wouldn't call that diverse. How far would you have to go to say something is diversified? Well, would it be owning 200 Australian shares? What if you threw in some international shares? What if you also had some fixed interest, such as a savings account or term deposit, or even just having cash at the bank? Does that mean that you're more diversified? It does. So for example, these are taken from our portfolios that we were speaking about just a bit earlier. And you can see on the left, there's the high growth. And this is how it allocates, or this is how the diversification works. You can see here that we have 43.56% in international equities or international shares. We have 39% in Aussie equities, Aussie shares. Then you've got some in property, some in cash, and some in fixed interest. And what this means is that if you were to add up your allocation to equities, you would see there's around about 82, probably 83% of your investment is going to be put into the share market, whether it be international or domestic. So here in Australia, high growth. This is why they're doing this. They put it into the shares so that it gets higher growth, but immediately it means that it's a bit more aggressive. So it is going to be a much riskier than, say, the conservative portfolio that we looked at before. It still has elements, though, of defensive type assets. So you can see there's 6% sitting in cash and there's 3.81% in fixed interest there as well. That's your defensive allocation. And there's also property and infrastructure, which has performed quite well over the longer term. But this year, due to COVID-related issues, it looks like it's underperforming. Balance, on the other hand, you can see there that there's a bit more of a balanced mix or allocation across different asset types. So when we say asset types, we're literally talking about things that you can invest in. So fixed interest is an asset. That means like term deposits or some kind of bond that pays you a regular amount of interest per month. So you can see that one's 33%, so a third of it is in a defensive type asset. The Aussie equities and international equities is at around about 46. Then you've got some cash, which is defensive again, and then slightly higher for property and infrastructure. And we get asked a lot of questions here at InvestSMART, as in, how do we actually do this? The asset allocation part, what do we put our money or your money in so that you get that exposure? And we do have all this on the website here. So if I was to show you the balanced portfolio, it'll actually show you. So here's the allocations that I was just talking about then. It's the same screenshot. And we go into key facts and we go to allocation. And what it does here, it shows what your holdings would be, or what the current holdings are for this portfolio. So what we do, and this is getting a little bit ahead of ourselves because we'll talk about this in the next week's webinar, but we invest in securities that are called ETFs, which is exchange traded funds. So basically they're funds that give us exposure or access to a certain part of the market, and they trade on the ASX, they trade on the exchange. A good example is the BlackRock iShares MSCI Australia 200, and it has the ticker code of IOZ. So you could literally go to your broker and you could purchase IOZ. You could Google IOZ and it would give you all the information on this particular ETF, on this exchange traded fund. So what we do is, for this balanced fund here, we say we're going to put 24.07% of your money, we're going to allocate that towards Australian shares. So we could go out and we could go to our broker and we could buy you each share individually. That would be quite time consuming. It'll also be quite expensive in terms of brokerage. So you'd be paying the broker each time you want to buy one of those Australian shares. Also, it's not just 200 shares that are, or companies that are equal in terms of percentages. It's actually slightly different, that they make up different sizes within this ASX 200. But if we are able to go to, say, BlackRock, and we can purchase just the one holding, those 200 shares are actually wrapped up inside it. So we can buy just the one. It's all managed for us. It gives us exposure to the top 200 by market capitalization. So it allows us to track the ASX 200's returns. And that's how we do it in terms of for Aussie shares. So we just need to buy the one security, which is this one. And then when we want to buy or get exposure to international markets or international equities, we don't just buy US shares. We'll buy something that has US shares, some Asian shares like Singapore shares or Hong Kong, European shares, English shares as well. So what we'll do is we'll actually, again, find another ETF. And in this case, it's going to be the Vanguard International Shares, which is VGS. And it works the same way as the Australia 200. So there's actually a mix of international shares inside there. So we would buy 22% of the portfolio, we'd put it into that. And that's what would give you that allocation or exposure to international shares. What does this mean? So you own the ETF, which means that indirectly you would be the owner of companies like CSL, Commonwealth Bank, BHP, Apple as well. Alternatively, if you've got the time, you've got the resources, you've got the cash, you could also go out and do this yourself, and you could buy individual shareholdings. But obviously it'd be up to you then to, through your own broker, monitor each day what is happening with the share. Should I sell it? Should I buy it? Should I rebalance? The managed portfolios do all of this for you, along with the tax reporting. And we cap our fees. So these are the different scales here. So $10,000 to $18,000 invested, you pay $99 per year. Between $18,000 to $82,000, it's 0.55%. But as soon as you go $1 over $82,000, your fee caps out. So the most you'll ever pay is $451 per year for us to manage this. And that just means that if you've got a mixture of different portfolios and you've got them with us, you might have $120,000, you might have $200,000. We've got investors that have millions of dollars invested. They only pay $451 per year. So always compare that. That's one thing that will slow you down if you're paying uncapped fees, particularly if the returns aren't there. We compare our returns to our average. There's 558 for the balanced peer funds. So we take the average of all their returns, and what we can see here is that we outperform, and this is most likely due to the fact that we cap our fees. So that stays in your pocket or your investment here, and it grows because of compound returns. So it's definitely quite a bit to take in. You're welcome to throw any questions you've got at me here as well. But you can always reach out at bootcamp@investsmart.com.au. And next week and upcoming weeks as well, we'll look at different topics that cover off different modules, looking at the different types of things to invest in, such as investment vehicles, we call them, the strategies that go along with them. We look at investor psychology towards the end. And then we also looked at some of the practical ways that you can invest based on what you've learned. Definitely reach out. What we might do is leave it here then, but until next time, thanks so much for attending.